Oil prices continuing to surge today after President Biden earlier today announced the U.S. will ban Russian imports of oil and natural gas in retaliation for the invasion of Ukraine. Take a listen.
Russian oil will no longer be acceptable at U.S. ports, and the American people will deal another powerful blow to Putin's war machine. This is a move that has strong bipartisan support in the Congress and, I believe, in the country. Americans have rallied to support their Ukrainian people and made it clear we will not be part of subsidizing Putin's war.
The EU and Britain also both announced today plans to cut gas imports from Russia by 2/3 this year. Meanwhile, Shell and BP say they will stop all spot purchases of Russian crude. Shell's decision comes after the company drew criticism last week for its recent purchase out of Russia. And for a much deeper dive on today's market action, especially with relation to oil, we bring in Ann Berry, Wheelhouse Chief Investment Officer, and she joins us now. Ann, good to have you here with us this afternoon. From your perspective, what did the markets give the most weight to from President Biden's announcement in order to initiate this kind of reverse course from the morning's declines that we were watching?
Well, I think it's some path towards at least certainty around what the U.S. foreign policy is going to be here. U.S. sanctions officially on U.S. oil, on Russian oil, was one of the sort of last outstanding economic tools that this administration had available to it to make a point on its stance against Russians. So I think it's becoming increasingly clear that the U.S. is going to try and lead the charge to now pressure Russia's ability to export to the NATO allies. And I think that was the key message coming out of today.
And now that we are seeing this reversal, at least for today in the major equity indices, do you think we've seen the worst of the sell-off? I mean, now that, like you said, now that we have that clarity, now that we actually have that announcement of the Russian oil import ban here in the U.S.?
I don't think we've seen the bottom yet, and I'd like to be more optimistic. But the reason I say this is when it comes to oil and it comes to other commodities, we're still seeing shocks making their way through the system right now, specifically in wheat and in corn. That was a big piece behind the volatility that we saw yesterday. And we're not done when it comes to oil and gas yet. You know, the UK and Europe has said by the end of this year, they'll start weaning themselves from Russian exports. It's not fast enough. And if the situation in Ukraine doesn't get better, I do think there's a scenario here where Europe will be pushed to take tougher action faster, which is going to send that oil price only one way, which is up from where it is right now.
And as you're mentioning there, wheat prices and corn prices, Russia and Ukraine together export more than a quarter of the world's wheat and supply a significant market share of corn exports as well. Now, higher prices on these tend to lift the global food prices as well. And this is coming at a time of 40-year high inflation in the US. How are you advising your clients to really manage risk on commodities right now?
Well, we focus on the private side. So where we think about who our clients are, it's the companies that we're supporting. And these businesses are trying really hard to figure out how to manage through supply chain shocks, which started, of course, through COVID. We spent 2 years talking about how businesses were struggling with shortages coming from COVID. And now these same businesses are having to try to plan around shocks to oil prices, input prices, further disruptions to transportation based on what we're seeing in this conflict in Europe. And so a lot of it's about hoarding cash. We're seeing that at the corporate level. We've also been seeing it too on the retail investor level. If you think about what people are trying to do right now, there's been some panic selling. People are talking about, do they buy the dip? Do they start, wading back into the equity markets? And at the moment, what we're saying to folks is, we've just got to wait and see a little bit. Now's not the time to start rolling the dice because we don't have sufficient global context yet on how we can plan both our personal and our commercial finances.
How much more difficult does this make the Fed's decision? Does this sway them at all with regard to the international conflict, the ramp up, the response from the White House, and now, of course, in weeks when they have their decision to announce that is going to have to still tackle inflation? Have we seen the best of what the Fed is going to put out there as of this point in time with regard to Fed Chair Jerome Powell supporting 25 basis points, where even prior to that, you had some of the other committee members supporting a potential 50 basis point hike?
The clarity that Jay Powell came out with and saying it's going to be 25 basis points in March and not 50, I think was a huge move. I do think the Fed's now in a really difficult position. Jay Powell has now come out and said, I was wrong, I'm paraphrasing, inflation wasn't transitory. And at the same time, he said, but we've got to take a steady approach to getting rates back up because we are in a moment of global turmoil and we just don't know which direction growth could go in yet. You know, the specter of stagflation, where you've got slowing growth and high inflation, is something that is now really hanging over the US in very real terms, and aggressive rate hikes could tip the economy the wrong way. So I think for Jay Powell, we know what he's going to do as a next step. But I think he's going to be treading carefully. He's going to have to wait and see. And it's one of those things he's had to wait and see for the last 24 months. He's going to have to keep doing that for the foreseeable future.
You mentioned in your notes to us that you view U.S. stocks as a safe haven asset in this market. Yet at the index level, we're still seeing volatility. You mentioned earlier as well that you didn't necessarily think we've seen the bottom here yet. So in what sense are you seeing U.S. stocks as a potential safe haven?
Well, I think where people are moving their money around, there are very few places they're willing to put them at the moment. When I talk to folks who are looking to actively invest, they're certainly not going to the European markets. If you look at the sell-off that you've seen in the European markets, they've been pretty steep so far. And again, if we think Europe is going to be pushed into taking tougher action, I think the only way is down for those markets. It's getting very complicated now in going to other markets such as Asia. If you read the geopolitical rhetoric moving into the Asian markets, moving towards China, just is very complicated until we know what China's stance on Russia and Ukraine is going to be. So for those who are looking to actively invest, we have seen them going into the US equity markets. We've seen them going into the US bond markets, and why yields have been extremely volatile. There seems to be no place else to go right now. So I would say I'm certainly not buying the dip personally, but when I do decide to start moving my cash, it's going to be into the US equity market.
And to that point then, for retail investors watching this then, if you're advising them perhaps not to buy the dip then, what should you do with your cash until then? Or what else looks exciting to you?
At the moment, I think it's just holding it. I mean, what I would be doing right now, and this is the sort of classic homework assignment, is trying to figure out which of those stocks, when some of this uncertainty peters out, which are the ones that would be the most on the radar screen, what's going to be on the shopping list. So for me, I spend a lot of my time tracking technology stocks. A lot of those prices have come down. But there is also, at least in my opinion, still room for them to continue going down a little bit further in what is ultimately going to be a raising rate environment. So it's building the shopping list. In some cases, I've been putting my cash into more dividend yielding stocks. There are ETFs out there that are dividend yield focused, so that at least if I am putting my capital out of cash and into equities, it's where I'm seeing some income streams coming out over time.